Good morning, and welcome to the SME Credit webinar. My name is Wendy. I will be your host, and thank you so much for joining us. We are currently live in Nairobi, Kenya. It's 10 a.m. where we are, and we're very excited to be hosting you today. So I just want us to make clear a few house rules. We would like you to use the chat feature at the bottom of the screen. If you have any questions on the Q&A section, please use that feature to ask any questions you might have for the speakers that we'll have today. This session will run from 10 a.m. to 11:30, and I am really excited because we have an amazing panel of speakers who will be talking to us about credit readiness, taking loans, and how to grow our business financially. And I can't wait. So just so that we can jump into the meat of things, my name is Wendy from the Sandbox, and I'll be your moderator for the day today. With me today, I have an amazing set of speakers, and I'll just share my screen so that we can see all of them, because again, they are doing some phenomenal things that I don't think we are ready for. So if you're new here, I've just said before, this is the part one of the SME Credit Readiness webinar, and it's going to be a three-part series that will be talking about practical engagement for SMEs and how you can be ready, so that when you go take a loan from the bank and they tell you absolutely you're not ready. So this webinar is just for us to unpack that so that we better understand what does it mean to be ready when it's time to take a loan from the bank. I want to introduce my speakers today, and the speakers for today are people in finance. When you think finance, you think, oh my God, it's going to be so hectic. So I want to introduce my speakers today, and these speakers some of them are experts at the Sandbox, and we're partnering with Hatua Consulting, who will be taking us through now the meat of things here today. So our speakers today, and I'll start by introducing the first person, who is Michael. Michael is the founder of Hatua Peak Consulting, and he works at the intersection of SME operations and credit decision making. He has over 17 years of experience in banking and helps businesses translate their financial activity into verifiable signals that align with the lender risk frameworks. So when you think taking a loan from the bank and who should help you make sure you're in the right place, Michael is the person that you should be thinking of. So just want Michael to unmute himself. Just say hello, good morning, as we continue.
Hello everyone. Good morning. Habari zenyu. How are you doing? And I'm really excited to be a part of this conversation, and I can't wait to engage with you. Asanteni sana.
Thank you so much, Michael. I will jump over to the next person, who is Duncan. Duncan is an audit expert at the Sandbox. So when you think audit, you think someone going through your documentation with a fine-tooth comb. So that is Duncan. Duncan is an audit expert at Sandbox with Duncan and Associates, and he brings together a wealth of experience in finance and audit. And I want to allow Duncan to just introduce himself as we continue.
Good morning, everyone, and I look forward to engaging discussion today regarding credit readiness. You're all welcome. Thank you so much.
Thank you so much, Duncan. Are you excited for today's session?
Oh, sure. Quite.
Okay. Next up is Doreen, and Doreen is what we like to call the lady with the money. So as she said it before, there is so much money out there. It's the how to get it that is the problem. So Doreen is the investor readiness expert at the Sandbox with over 10 years experience working with SMEs. She has a strategic and hands-on approach with top skills in capital raising, finance modeling, investor relations, and due diligence. She is the founder of Insight Hub Africa, where she supports businesses to position, prepare, and successfully secure local and international funding. So I'd like to say she's the Miss Money. Like, when you think I need money for my business, she's the lady you need to be thinking about. Karibu sana, Doreen. Doreen, I think just say hi to us this morning. We can't hear you, Doreen. Doreen, we can't hear you. Hello. Doreen, we can't hear you. So that's the challenge I'm having with you right now.
Hello, can you hear me now?
Yes, now I can hear you. Yes, I can.
Hello, sorry, can you hear me now?
Yes, I can hear you properly.
Apologies for that. There's some tech issue. It was refusing to unmute. Thanks for the introduction, Wendy. Looking forward to participating on this webinar.
Do you have money for us today? That's the question.
Yes, I have lots of money. Maybe not so much personal money, but I am aware where you can find the money, if that helps.
Okay. And lastly, I want to introduce Simon. So Simon is a tax expert at the Sandbox. So when you think KRA, tax collectors, Simon works with the tax collectors very closely. And Simon is a seasoned tax consultant with over 7 years experience in working with SMEs. He is strategic and solution-oriented in his approach with top skills in tax advisory, regulatory compliance, finance optimization, and business strategy. He is currently the Tax and Regulatory Service Director at Coplight Consulting, where he specializes in resolving complex tax challenges and implementing tax-efficient strategies to help businesses achieve financial success. Karibu sana, Simon. Please just unmute yourself and introduce yourself. Just say hi to us.
Yes, good morning, everyone. As Wendy has introduced, I'm Simon, and I'm happy to join us here. Tax compliance is one of the components that the financiers look when they want to give credit. So I'm here to support on that sector so that we can be able to get the finance that we need. So looking forward to a productive webinar ahead. Thank you.
Okay, thank you so much. Thank you so much, Sam. I really do appreciate. And as I mentioned earlier, this webinar is a 3-part series in collaboration with Hatuapi Consulting, just for us to unpack what does it mean to actually get credit? What does it mean to actually get a loan from a bank? Financing, either alternate financing, and I think the panelists today will talk about alternate financing and traditional financing and all that. But before we continue, if you're new here, we are the Sandbox. So the Sandbox is an aggregate of business professionals, and we like to think of ourselves as a supermarket, a one-stop shop for entrepreneur growth solutions. So when you think about what your business needs, think Sandbox. You walk in, you will see someone in tax, you will see someone in audit, you will see someone in marketing. All of us are here to support entrepreneurs, and we look at our approach as holistic, collaborative, and practical, because again, it has to make sense for your business. And we also like saying that we want to help businesses build unique, profitable businesses that are scalable and keep you accountable to your goals. So we like saying that we are building generational businesses and not lifestyle businesses. So think in 2 years' time, in 3 years, in 10, not even 2, in 20 years' time, our children will be taking over these businesses. So we're supporting the dream of building generational businesses. How we support entrepreneurs is through our experts and the expertise, and some of them will be speaking at this webinar, and this is how we support our experts. And we currently have 28 experts based here at the Sandbox. So when you think that you need support when it comes to strategy, tax, marketing, legal, personal speaking, team dynamics, mental health, think the Sandbox. We are your one-stop shop for entrepreneur solutions. As I mentioned earlier, please use the chat feature. If you have any questions, use the chat feature to ask. We're here to learn. We're here to learn from each other. We're here to ask. The experts are here to actually teach us, show us the way of how to do it right. And from here, I'd like to hand over to Michael, who will now carry the meat of the session. And Michael, maybe just as a start, when we think about, just before we get into the meat of things, when we think about being alone, I know we have some people who said, I don't like how it's so frustrating, or the wait time is so long, or this is what happens when why are they asking me for so many things? I think just start with the why. Why am I being asked for 526 documents for some little money,
Okay, thank you very much, Wendy. And yeah, that's a common complaint or a common frustration that business owners have. Why am I being asked for all these things, and yet my business is sound? Everything about what I'm doing is seen. I have a business which is thriving. So to set all this, let me paint a picture. So when you as a businessman or as an SME owner approach a bank, you are approaching a system. So there are different players with different motivations, and there are different tensions that are going on. So there's the bank, there is your relationship manager, if you have one. If you don't have one, that starts, your pain points start there. Then there's a credit analyst. So I'll start with the bank. The bank has what you call a credit policy. So this credit policy is the playbook, which informs all the people in the bank who to lend to, for how long, how much, what conditions need to be met before a loan is advanced. Because many people don't realize, but banks deal with risk. So they have to balance between growth and profitability and risk, because any loan that is not paid has to be provisioned for. And by provisioning means you have to provide a buffer so that the money can be recovered. And Duncan, who's the auditor and the accountant, would go into depth about that. And this, when you start provisioning, it affects the profitability. And that profitability, once it's affected, it affects also the shareholder value. Internally, it will affect the bonuses that the bank employees get. So that's a balance that has to be made. Then you have your relationship manager. Your relationship manager is very critical because he's the link between you and the bank. So your relationship manager has to understand your business inside and out so that they can advocate for it, because they have to present it to the bank in a manner and in a format. Remember the playbook that I mentioned that fits the credit policy. So if you don't explain, or sometimes, as is our habit as Kenyans, we wait until the very last minute. I have a tender, I need to supply these things, so I need my loan to be approved in the shortest time possible. And let me inform you, ladies and gentlemen who are on the call, if you force a bank to make a decision without sufficient information, the answer will be no, because there's another person called the credit analyst, whose job is now to look at this whole information that has been packaged. There's qualitative information, which are your financials and your statements. And also there's the quantitative information, the information about your business that your relationship manager has to know and then present in a way that is verifiable. Actually, the word is verifiable. So your business might be doing well, but if you don't tell this story in a way that the bank can verify through your statements, through your financials, and Duncan will tell you more about the financials, then the answer will be no. So these tensions have to be put in place. And these two people, the credit analyst and the relationship manager, are taking their reputation. Because if they approve, if your loan is approved and they are the ones who presented, in any committee meeting, in any audit meeting, that loan comes up, especially in the event that you're not paying properly, their reputation will be on the line. So your relationship manager has to sit, understand your business, take the financials, package it, give it to the credit analyst. The credit analyst has to use the playbook, which has the rules and the requirements, and then present it to the bank for approval. And then we hope that circumstances will not change somewhere down the line. And for most SMEs, getting the loan is the finish line. But for the bank, that's where the relationship starts. It's a wedding and the marriage. So for sometimes the end game for some people is to get married. But there's the whole marriage that goes on for 3 years or 5 years for the tenure of the loan. So for the bank, there's the monitoring, there's the reputation at stake internally. So those are the tensions which you come in. So Wendy, I don't know, has that given you context into the kind of arena that you play in?
I think it has. I'm still stuck at the part for when you force, because I can't imagine forcing a bank to give me money. Like,
well,
you know, I can't imagine, like, you know, someone like, you know, gun to my head, forcing the bank to give me money. So it's very interesting how there are so many people that come into play when it's time to give a business money. So I love where the direction this is taking, and maybe I think maybe this is maybe a cue for you to not just bring up your screen, because just now we can walk through the journey of what it means to be rejected again, because rejection is a big thing that happens when it comes to entrepreneurs taking loans. So I think maybe it's a cue just to bring up your screen, just that we can also just have a broader picture of what it looks like and what the rejection reality actually looks like.
Okay, so could you help me with that? Because I'm not
happy
seeing.
to.
Yes, thank you very much. And just to respond to you, when I say force, what I mean is sometimes there's a time crunch. You know us. We wait, and Simon will confirm. We wait until the very last minute to file our taxes. The same thing happens to businesses when they need a loan. They wait. Okay, not wait. Sometimes circumstances push them, and they have a month sometimes or 2 months lead time before they need to supply something. And that now forces a hurried preparation of documents and packaging. And like I mentioned, you have to explain your business in a manner that the bank can verify. Actually, the key information is verify. Explain your business in a way that the bank can verify the information so that the decision can be made easily. Yes. I think
I love that. So I'm hoping everyone can see my screen.
Yes, we can.
Okay, I think this is over to you, Michael, now.
Yes. So like I said, what we are doing during this session is to actually tell you, and I've painted the canvas. That's the background. So the canvas is you're entering into this system. And also I need to mention that also the choice of bank matters, because there are some banks which have an affinity for certain products and certain kind of businesses. So their risk appetite, like I mentioned, all lending is risky because the realities that are present now change sometimes due to regulation, sometimes through economics, politics. They change. So you also need to be aware that the choice of bank matters. And that's why it's very critical to have a relationship with your bank. Know your relationship manager, because sometimes you could be lost in the forest. You're one of 300 customers or sometimes even more. So if you're not seen, your relationship manager cannot advocate for you in a manner that the bank can verify the information that you're providing. So Wendy, the next one. So that's what we are doing, what banks think, rejection reasons, and then a diagnosis. So very quickly, this information was gotten from a survey, the 2024, which was prepared in June of last year, looking at the landscape of MSMEs, medium, small, and micro enterprises. It's stark reading because approximately 75%, and I'm glad that Sandbox, like it has been mentioned, is a supermarket of talented experts, because some of the reasons why this is done is about documentation and issues that can be corrected. So stark reading that almost 75% of loan applications are rejected. And like I mentioned, it enters into that tension, that environment. There's a credit policy, there's the verifiability, the predictability of income, and also the information that is being read, the statements, they are in the past. So you're using past information to make a future risk on what will happen. So with that rejection rate, it means that there is about 5 trillion credit gap. And here, Doreen will speak to where else can you get credit once you're rejected and this gap. Because for me, my background is in banking, but Doreen will let you know how this can be bridged. And then informal records. Yes, a lot of us have information somewhere in a book or sometimes even in our heads. So if a bank can't see this information. Who are your clients? And not all businesses in the same industry are the same. So if a bank uses broad strokes or generalizes, then it might be to your detriment, because there's certain information that you need to provide to mitigate. Because there are some industries which have 20% non-performing rates. But you could have a certain kind of specialization, a special contract that mitigates this risk. So you need to have records, proper records. And Duncan, who's in audit, will tell you the importance of governance and record keeping and all these things that come together to form this. And then for most businesses, there's a 3-year wait time from when you think about having a loan to when you can actually be ready to be approved. Because you remember there's the playbook. So if you have to wait 3 years, your business cannot grow. So you'll have to look for alternative funding. Once again, Doreen will let you know, as you're waiting for the 3 years, what alternatives do you have? So yeah, so only 1 in 4 formal loan applications get approved. That's a 25% chance. So can you afford not to have this information? Are you willing to roll the dice that you are one among the 4 loan applications that are going to be approved? And at this point, maybe I would ask Doreen, because Doreen is in the also alternative investing, to weigh in and maybe give us her point of view. Doreen.
All right. Thanks for the invitation, Michael. Yes, you raise a very valid point. In fact, I think my question that I would want you to answer after this is, what is the primary reason for this rejection rate? Of course, you mentioned, numbers and all of that, but I'd like to understand the SME mindset. Is it that they don't know or they're not willing to do it? I'll let you answer that to this. I'm also interested in, the banking sector, of course, because of what I do. But to answer your question, so banks typically would only lend based on your historic performance, as you have rightly put out. What they're looking for is, can you pay me back? Number 1. And number 2, when can you pay me back? Right? How long will it take you to pay me back? And number 3, if you're not able to pay me back, what can you give me? What can I take from you so I can secure my loan that I've given to you? So that's how banks think. So there are other debt lenders that think differently. They think about the future. So most debt funders typically look historically. So the reason why they look at your historic numbers is because they need to understand that you are able to pay them back. And they need to understand how much you're willing to pay them back. In fact, there's an important ratio that they use called a debt service coverage ratio. And that number will tell them how much you can pay back and how well you can pay back. And so that's very important. And that's why those historic numbers are very important. However, we do have other debt funders who could be in the private equity space. I know it's private equity, so equity is shareholding, but you actually have private equity players who actually give debt, and you have venture capital players who actually give debt. So they look at the business differently. They look at, where is this business going? And can this business in the future be able to pay off this debt? So recently, we connected a health tech platform to a debt funder, and they were very interested in understanding the unit economics. How much is this business making, and when will this business be able to generate sufficient cash in order to pay this loan? And so our job as investor readiness experts is to do the financial modeling, pitch deck preparation. So in the financial modeling, you'll be able to lay out what the future cash flows of the business would look like based on certain assumptions that you have made. And so when you look at the future and you're able to see, okay, this business in 12 months will be able to pay this amount. So let's give them a 1-year moratorium. So just a disclaimer, for you to be able to access some of these funds, it's not just, oh, I have this great business, I can make money in the future. No, some of these funds are very focused on impact angles. So if you're creating a specific impact, if your business is in a strong impact space, it is possible for you to get debt even when you're not actually profitable. As long as, and sometimes it's less easy now in the market. There's a lot of capital world dynamics going on right now. I won't get into that. It was easier to do this maybe 2 years ago, but right now, if you have a strong impact angle, it is possible to get debt, as long as you're able to showcase that you're able to start covering that debt within a short space in time. And when I say short space in time, that's around 12 months. In addition to that, I'll just talk about the information that you need. In terms of, you will still need everything a bank would ask for, and more. In fact, private equity and venture capital due diligence is 100 times heavier than. So if you're complaining about banks and the requirement, you'll be very frustrated if you bring that mindset to private equity and venture capital. I hope I've answered your question.
Thank you very much, Wendy. And you asked Doreen, why am I calling you? Wendy's on the other side. Apologies. Yes. And Duncan, when we talk about records and financial statements, could you speak to that? Because for me, when I was on the other side, what we looked at were management accounts. What are management accounts? Balance sheets, projections, cash flow, income statements. Duncan.
Okay. Thank you so much, Michael. Yes, and the statistics that you've given, that 67% of SMEs do not have formal records. The business owners only have records in their minds. There is nothing to show that this is how much I made, these were my expenses. Yeah, so that's how auditors come in. There is no bank that will give you funding if they cannot be able to verify your records. If you do not have anything in place to show that, well, these are the records that I have, showing how much I made within a particular period, let's say, be it monthly or say annually. These are my expenses. This is my net income. These are my assets. These are my liabilities. These are my cash flow projections. This is this equity statement and all that. If you don't have that, then you're likely not going to be listened to by the banks. Now, Doreen just mentioned about something quite important, which is debt service coverage ratio. Now, apart from that, there are many other things that the banks will be looking at to analyze your business and see whether you'll be able to pay them. I'm not going to be very technical, but I'll just highlight some of the ratios that they look at. Of course, there is something called the monthly turnover. So they just look at the sales that you are able to make within a month. And one of the things the banks will be looking at is to see how consistent those sales are. You cannot, let's say, if you have some unusual sales, let's say in 1 month, your sales that are, let's say, 10 million, the next month is 1 million. Now, that kind of consistency, of course, inconsistency will bring a lot of questions from the bank. There is what we call the gross margin, which is ideally the gross profit over revenue. And by gross profit, we are talking about the sales less the cost of sales. In other words, how much your gross profit is the difference between your sales and how much it costs you to generate to get those costs. For example, if you are buying goods and let's say you're a retailer, you buy goods and then you sell them. So how much you'll have sold and then against how much you spent to obtain those goods, that's what we call the gross margin ratio. So the higher the ratio, the better credibility for you. Then, of course, the debt service coverage ratio, which Doreen talked about. The bank will also be looking at your cash flow consistency, which again has to be steady, predictable, there has to be steady and predictable movement of cash in and out of your business. Many other things like owner equity, which generally is the assets you have against the liabilities. Then they'll also be looking at your history of retained earnings, which ideally is the cumulative net income, which is kept or reinvested in the business after you've paid out dividends. Now, going to the kind of records one needs to keep for their business. And I just have to reiterate that no lender would wish to put money in your business in the absence of internal controls. So even before we go to the internal controls, I'll talk about the records that need to be kept. So you'll need to have your profit and loss statement, which summarizes the revenue, costs, and expenses to show profitability. There is the balance sheet, which displays the assets, the liabilities, the owner equity at a specific point in time. Then there's the cash flow statement, which I've talked about, which is ideally tracking money in and out of your business. And it's quite critical because cash flow issues are a major reason for loan denial. You may have a strong balance sheet, but let's say most of your money is tied in your debtors, then you'll have a problem meeting day-to-day expenses. Then there is what we call the aging reports, both for account receivable and account payable. So these aging reports, they break down the money owed to the business and the debt owed to suppliers required for working capital loans. Then apart from that, you also need to have your tax and banking records. And I know Simon will talk about some of them, but if I may just touch briefly on them, you need at least 2 to 3 years of filed business tax returns, showing how income was derived at. You need to have your bank statement. Most banks would ask for at least 6 to 12 months of your bank statements, which the lender is able to use to verify the actual cash transactions. And then there's something called a cash flow projection. Doreen briefly touched about this, but ideally it shows the projected income and expenses for the next, let's say, 12 to 36 months, which ideally demonstrates the ability to repay the loan. Then, of course, there's the business plan, the projection report, which outlines the company's goal, the market strategy, and specific purposes of the loan. You'll also require legal and collateral documentation, things like business registration certificates. And the purpose of that is just to show proof of legal existence. Like I said, you'll need your tax compliance certificate. Simon will talk about that. You'll need other documents like collateral documents. Let's say you have property like land, motor vehicles, and such. So you need property titles, vehicle logbooks, or asset registers to secure a loan. You'll also need other legal documents like memorandum and articles of association, board resolutions for borrowing and existing loan agreements. All those need to be available. Now, how does an auditor come in? The auditor ensures that once they have all these documents, they're able to verify each and every thing that the business, rather everything that the business is demonstrating to put across. Let's say if they say that these are my profits, then of course the auditor has to come in and they have to verify that all those records are there. Another thing I need to mention is that generally in Kenya, you need to keep this proper documentation, and I think there's a time frame for that. Ideally, it's 5 to 7 years if you comply with the Companies Act 2015, and of course the Tax Procedures Act. Simon will be able to say whether there's a variation to that, but there may be other requirements whereby you need to keep those records at different length of time. Now, when the auditor looks at the financial statements, there are normally 4 types of opinions they normally issue. So I'll just run through the 4 types quickly. And the most favorable report that any business should aim to have is the unqualified opinion, which is a clean report. It shows that the financial statements are presented fairly and in compliance with all the standards that are available. Like in Kenya, we use the International Financial Reporting Standards, which implies that the records are free from material misstatement. Now, if you don't have if the auditor is not able to express an unqualified opinion, then there's what we call a qualified opinion. And this is usually issued when the auditor concludes that most of the financial statements, yes, they are fairly presented, but there are specific items within there of material value that deviates from the accounting standards. Then there's what we call adverse opinion, which is normally issued when the financial statements do not accurately reflect the company's financial position. They do not conform with the standards and contain widespread material misstatements. Then the last one is what we call the disclaimer of opinion, which the auditor normally issues if they are unable to obtain sufficient appropriate evidence to form an opinion, often due to a significant limitation in scope or lack of access to records. So I hope I've answered that, Michael.
Thank you very much.
I think I have a few questions, maybe just with regards to Duncan and what Duncan has said. First of all, this is the first time I'm hearing someone say qualified and unqualified are used in the opposite direction, which I love that there's so much clarity in terms of what it means to have a qualified opinion, what it means to have an unqualified opinion. I mean, those are things I didn't know, so I'm hearing this for the first time. But I'm also understanding that actually getting a loan feels like selling your soul. You know, this document, that document, a collateral for a house, a car, it feels like I am selling my soul to the highest bidder, you know, and all I'm asking for is support in my business. And I'm a bit shocked. So what happens? Like maybe I just take this back to Duncan just by a bit. What happens when, okay, fine, I've given you all these things, and then you don't give me a loan? And then do they tell you why? And maybe now this is where Michael comes in. Do they tell you why they didn't give you a loan after selling your soul?
Thanks, Wendy. Yes, the terms are quite confusing between unqualified and qualified, and you are not the only one. We've had these challenges, even not just with businesses, even with county government. I remember, if you may recall, a few weeks back, one of the county heads was very happy that the county had been given a qualified opinion. And we had to tell them that he needs to understand what he's really talking about. Yes. Yeah. So, like I said, all businesses should aim to have an unqualified opinion, which is a clean report. If the report is anything else apart from unqualified opinion, then you are unlikely going to get a loan from the bank, because it shows that whatever records that you're presenting have questions, they have issues.
Okay, so maybe just to engage our people on the webinar, I'd like to just ask, can we just, have you been audited before as a business? If yes, what did you get? Like, did you get a qualified opinion, an unqualified opinion? What was the response you got from your auditor? And if you haven't been audited, why? Like, why haven't you been audited? Because I'm really curious just to understand, with the businesses that we have on the call today, where do you stand when it comes to being audited, and how do you feel about it? And maybe Michael, just over back to you. After Duncan has made sure that I've gotten a qualified or unqualified, let's say I got an unqualified, a qualified audit report, and I got rejected. So what happens? Like, after I've sold my soul, all these documents I've given the bank, and they reject me. What happens next? Like, do you give me the reason as to why I didn't get the loan? Like, do you call me back and tell me, so Wendy, you didn't get the loan because 1, 2, 3?
Thank you. Ideally, and this is why I stress that you should have a relationship. And the more information you give the bank about your business, the better. If they understand your business well enough, they will be able to tell you, correct this, because you have an aging, the aging report which Duncan had mentioned, maybe your receivables, because all these documents that Duncan has mentioned, they tell a story. And the story that the bank wants to hear is, if we lend you X amount for this particular period, at this rate, your cash flows demonstrated by the financials and the statement show us that we have a reasonable expectation that we will get our money back. Remember the scenario I painted. So the credit analyst won't be asked when this loan goes bad. The bank will not have to provision. So shareholders will get their money and the bank employees will get their bonuses. So you see, so as a business, let's be alive to the fact that a bank, if it can't verify your cash flows, and then one thing that I see is there's, and Duncan may not have mentioned this, there's something called commingling of funds. You and your business are two separate entities. So I know we've just come from paying school fees, and I'd like the audience to ask themselves, how many of you directly moved cash from their bank, from their business account to pay school fees? That in itself, when the credit analyst sees, and Duncan will verify, it shows that there is weak governance. You and the business are not the same. Ideally, what you should do is that you pay yourself a salary, you take drawings or a bonus. Duncan, am I right? Because
Yes,
I'm stepping into it.
Yes, you're very right. Yeah,
Sorry?
it's very important for the business to have strong governance in place, whereby you separate the business from yourself as an individual. Let's say if you pay school fees from your business now, again, that is going to bring a lot of questions from the bank when they'll be analyzing your financial statements. So the best scenario where we normally tell our businesses that you as an entrepreneur, you need to pay yourself first. Then whatever you pay yourself, that is where now you need to meet all your expenses from there. Do not get payments. Do not make payments directly from the business for your personal thing. So you first of all set up your salary, which you'll be receiving every month or periodically, whatever it is. Then make your personal payments from that. They should not appear in the business. Commingling of funds, again, let's say you have different businesses. Maybe you are running 2 different businesses or more. Then there is what we call related party transactions. Again, those ones need to be very, very clear. And you have to take into consideration that there should be no commingling of funds. Back to you, Michael.
Thank you. So with all these records that are being asked for by the bank, like I mentioned, there is a story. And one of the ones that actually, and Doreen, you asked this, one of the biggest things that bankers see or analysts see is where the statement, because when we're looking at the financials that you've provided and the statement, if there's a discrepancy of 30%, there's a variance of 30%, the bank will look the other way and say this is an unacceptable variance. If it's 50%, they will call you and ask you, how come we are saying this in your financials, that these are the inflows and outflows, and we can't see the same being reflected in your statements? They will ask you to explain. Anything higher than that, the bank will reject, because there is no correlation between your statements and your financials. So when you're entering into this conversation, back to answer Doreen's question, is the bank cannot verify. There's the statements, the bank statements and the financials, and these two do not speak the same language. And for very many of us, sometimes we don't bank as frequently. Sometimes we see round figures. So we start saying that every morning you bank 50,000. So are we saying that all the sales are 50,000? That is unrealistic. So inconsistencies. And that can also mention that this month we see your bankings are 10 million. Then next month we see that the account turnover is 4 million. Such huge discrepancies. And the money has been received, it's just that some has not found its way to your statements. So there needs to be the discipline where both every income that you get at least is routed through the bank. And then also another thing is we see money coming in and immediately out. So we see you banked 50,000 or 50,168, and then you withdraw 50,000. What is left in the account? 168, and that happens consistently. That is not in the normal cycle of doing business. So we need to learn certain habits that are able, when an analyst looks at your transactions and then the documentation, the financials that you've been given, there is no huge discrepancy. Okay? I think that is very important to mention, because that, for me, has been and continues to be one of the biggest challenges and reasons why applications get rejected. And will they tell you? Some will, some won't. I'll be very honest here and say some will, some won't. So that's why we're having this conversation, so that the people who are in the audience can understand that this is what the bank is looking out for. The documentation that Duncan has mentioned, and then the predictability. Can we verify this information? Wendy. So
well, before
Just to
when,
ask,
maybe I may just need to jump in a little bit, Michael, just to put an emphasis on what you said. Actually, your business may look profitable on paper, but you'll still face a credit decline due to what we call quality of earnings, which
yes,
signifies that the reported profit is not reliable. For example, just if I may use the example that you just mentioned, whereby you put 50, you deposit 50,000, then the following day you withdraw, or almost immediately you withdraw. Then of course that is might signify that the profit is not reliable, and it may not be sustainable in the long term, or it cannot be easily converted to cash. So the lenders usually look beyond the bottom line. They don't just look at the profit to assess if the earnings are recurring. Rather, they look at how the quality of those earnings. Now, I'll give you another example. Let's say you had an insurance policy, and then maybe let's say there was a fire, and the insurance company compensated you. Of course, that would come into your P&L, and it will boost your earnings. So the lenders will not just look at the bottom line to see, yes, you made a profit. Or let's say, for example, you sold an asset. Let's say you had a motor vehicle which you sold. Now, there'll be gain on sale of assets, which of course will have an impact on your P&L. Definitely it will boost your profitability, but that will not make the lender look at you and say your profits are reliable, because those are what we call one-off occurrences which would affect the P&L, but may not necessarily say that your business is doing well. Back to you, Michael.
Thank you.
Maybe
yes, Wendy?
Michael, just to interject a little bit. So from
Yes.
my understanding, I think you've said something that anything, if the variance between your bank statements and your financials is 30% and under, that's the bank will give you the loan, correct?
Well, let me say this, that the bank will say it is reasonable.
It is reasonable. So that's,
It is
yes.
reasonable. Yes.
Mm-hmm. Then so 50%, they'll be like, I think let's just gain some clarity and call this person just to confirm what is happening here.
Yes.
And then anything above 50, they're like, this is a big risk, too big to take, cancel next.
Yes, and remember I said there's qualitative and quantitative. That's just the quantitative. There's a qualitative. So when you say yes, so you'll have passed the first hurdle, the quantitative, which mostly, if you can pass the quantitative hurdle, the qualitative is easier, because the qualitative is understanding your business and the risks that are inherent in the business. Okay, let me not call it easier. It's just a different hurdle that now you have to pass. And this is where, ideally, your relationship manager should understand your business. Who are your customers? There's something called concentration risk. Does one client constitute 30% or 50% of your earning? If that is the case, then that is a problem. Because if this customer cancels, then that will obviously impact your business. Another one is key man risk. And those of us who are consultants and running consultancy, there is a key man risk. So you are the business, you are the talent. So what happens to the business if you are incapacitated? That also needs to be taken into account. Now that takes the qualitative approach, the risk analysis bit of your industry and your business, the economic environment. So the documentation bit, I think once you develop the rigor and the discipline to have that in place, because if I was to do a poll right now and ask the people who are on the attendees, how many of you have management accounts or your books? We are in May. How many people have their audited financials for the previous year? It would be...
We can do a quick poll just to ask.
Yes.
If we have... This is audited accounts for 2025, right?
Audited or management accounts?
It's coming up, audited/management accounts for 2025. So
because as you're doing the poll, that normally it's a rush job. And you see, you'll do the rush job, you'll get your accountant or someone. And by the way, also, it has to be from someone who's a registered, who is in good standing with the accounting body. You can't just get anyone, because if you do, then that also impacts.
Okay, so I can see the results on this end. 2 people are saying yes. 7 people are saying no, they don't have audited/management accounts for 2025.
If we were to do a percentage, you remember I said 1 in 4. You see the numbers bear me out, or bear the statistics out.
Yes.
And
so I can see 3 have said yes, 11 have said no. So I think we just keep voting, because it really affirms the 1 in 4. Again, the 1 in 4 is really coming into play here.
Yes. So again, if we dig deeper and we say, of those ones who have, if we looked at their statements over the last 12 months, what will I see? Or what will the analyst see? How many of them paid school fees through those accounts? Or there is a personal expenditure through that account, it will be damning. Now that's why you see the rejection rate. So I want people to look at it from the bank's lens. Yes, you have the vision, you're passionate, you believe in the business. The bank has to bear the risk of something going wrong. So let's go back, before we get to this, let's go back.
There's something you've said, Michael, and I want to just ask a question around mixing how you spend the money in the account, for lack of better term. I can't remember the term Duncan said, but where you pay school fees. Yes, commingling of funds. Commingling of funds. That's a new term I have learned today. But in that regard of commingling of funds, is this where you actually have, it's not you, is this where accountability systems in the business come in, whereby it's not just you who is running the business? Like, let's say you've hired a finance person, whereby technically they have to approve for you to withdraw money. I don't know if that makes sense. Is this where accountability systems come in, where they hold you accountable and say, you have to have a salo where you can pay your school fees from, but you can't take money from the business to do your business, to do your personal things?
Yes, the narrations in the statement matter a lot. And governance, this is now in the domain for the auditors. If you have the proper governance in place, they should arrest those things before they happen. So a lot of SMEs are not aware. It's like you asked previously, is it that they are not aware? The answer is yes, they're not aware. They just think, I mean, it's school fees. I mean, it's a spa. I have a spa outing or a dinner. It's not a business dinner, but it's just something. So we look for that. And even now with the mobile loans. So if I start seeing an infusion of mobile loans into your accounts, it also tells me something. So there needs to be proper governance around account conduct. So if that is in place, then it sends the right signals to the bank.
Okay. I love that. Maybe just to publish the results of the poll we've just done, 70% said no, they don't have audited accounts, and 30% said yes, they do have audited accounts.
Fantastic. So if you don't, this would be a good opportunity to contact one of the experts from Sandbox, because without that, then if you are looking at loans or getting funding through banks or financial institutions, then that will be a problem. And I also want you to look at your statements over the last 6 to 12 months. Now, there is where the story will be dire. I suspect, because that's what is seen. So Doreen had asked why. Okay, before we go to this, or I'll speak to this, then go back briefly. Some of the reasons why we are rejected is like we've just seen. If you have no audited or management accounts, the bank can't confirm what you're telling them. It is a story. And given the environment, because the risk inherent, if I can't verify what you're telling me, then obviously the loan will be rejected. And I know over time, we've gotten accustomed to CRB. So CRB listing is, you could have your partner who defaulted on a mobile loan or HELB or anything else. So you need to confirm that none of your partners or you are not listed. And if you're listed, now also you remember the credit policy that I mentioned. There are some banks which require you to have a cooling off period. So let's say you find out that you are listed because of a mobile loan, for instance, and then you pay it off. Some banks will require a cooling off period of 3 months, some. So it's good to find out from your relationship manager, because that is a credit policy issue and it's internal. Some will require that you just pay it and we move on with the application. But also remember that you've already started raising a flag, because it will still be in the file that so-and-so was listed. Just remember that it will still be there, okay? And then the other one is collateral. And the number of people who come and tell you that I have a title. So that should automatically, there's a misconception, a common misconception that once you have a title or a logbook, then you're good to go. After all, if I don't pay, you'll sell. But you know, the bank is not in the business, or the financial institution is not in the business of selling cars and plots and buildings. So before they even get to the title, they have to establish that your cash flows can cover the loan repayment. And that's where Doreen and Duncan mentioned the debt service cover ratio. For some banks, it will range from 1.25 to 1.5, meaning that for every 100 shillings of loan repayment, you need to demonstrate cash flows of 125 shillings or 150. But the bank won't tell you. That's why I'm here. So there's the debt service coverage ratio. So if your cash flows are calculated, it is, just know it's between 1.25 and 1.5. Okay? And then this one now is business cannot demonstrate your cash flows. If your statement shows irregular income, round number deposit, high cash withdrawals, it raises a flag, like I mentioned before. So the interpretation from the analyst would be either you're hiding something, you have weak governance, or your business is not, let me say you're guessing, as I wrote there, but I don't like the word you're guessing, because that would be an insult to the business that you're running. And some of these businesses are profitable. And once again, Duncan will say profitable on paper, but you need to demonstrate to the bank. And all that is tied to weak business governance. And in governance, you'll wonder why a business is asking you for a business registration, permits, and all those things. A permit shows that you have an abode and there is stability. And if you're registered, of course, we can get some information about you. If you have unpaid KRA obligations, it speaks to your character. And that's why I wanted us to go back to the previous slide. So if you are unable to pay those obligations, the bank will say, we are not special. So it speaks to your character. So Wendy, if you could go back.
Yes, I could go back.
This slide now tells you what the bank will actually think about you. And the first one is, can I trust this person? So you've come, you've told us the story and the reason why you want to borrow. Can I trust you? And trust is built if I can be able to see that you have a clean CRB history, your loan repayment record is good, and also the time with your bank. So if you have a relatively new record, think of it like any vendor. You've seen someone selling something online, they don't know you, this is your first instance with them, you can't hope for them to give you credit. There's a trust deficit. So that has to be built. So the bank first asks, can I trust you? And then the other one is the capacity, and this speaks to the documentation that you'll provide. Is there a consistency in the cash flows? And this speaks to the debt service coverage ratio. For every 100 shillings we lend you, are you generating 125 or 150, depending on the policy that that bank has? And then your monthly turnovers, can we see them? The balance sheet and the income statement show us one thing, but do your statements speak to that? And then obviously, and that's why banks do not fund startups. How much skin do you have in the game? And Duncan also mentioned owner equity, retained earnings, asset contribution, and percentage of your own funding. That's why sometimes when you go for an asset financing, they tell you pay 10% or 20% or sometimes 5%. Or when you do a mortgage, they tell you, we need you to put in a 10% deposit. They need to see for you to have skin in the game, because if you have skin in the game, you have something to lose. If I am only losing your money, the possibility of me not taking it as seriously is higher. And then collateral. This is very, very important. There are some which are unsecured, some loans which can be done, and they can be done. When I say unsecured, is your cash flows will speak to the ability to repay, and the bank will not require you to provide any security. And when I speak about collateral, also understand that if you're charging land or if you're providing land, you will not receive any funds from the bank until that title is fully secured by the bank. And it's called perfection of security. So, and sometimes that is outside the control of the bank. The land board meets, so there is a search which has to be done. There's a valuation which has to be done, a search which has to be done, lawyers have to be contracted, stamp duty has to be paid. You have to go to the lands board, initiate the transfer. The bank has to be noted there so that there is an encumbrance, or meaning that the bank is noted as an interested party in that title. So that takes sometimes, depending on which land, where your land is located, it could take anywhere from a month. Sometimes even I've seen even some taking even 6 months. So even that is even a year. Yes, Duncan, even a year. Yeah. So until that security has been secured or perfected, you will not see a single cent of the funding that you're looking for. So that's also a key consideration to have. Sometimes we blame the bank, but that has to be in place. And then lastly, does the sector make sense? And once again, I go to the policy. Which sector are you? Are you in trade? Because if I look at the report that the CBK SME, it was called the SME analysis report. It's available in the CBK website. Banks really like trade business because the cash flows are the inflows and outflows are very quick. Some industries are risky. So the risk component or the risk loaded on different industries are different. So you're in construction. So ideally, the banks, from that report, the banks prefer trade first, real estate, then the third one, and I'll look at it, it could be transport. So if you're outside of that, once again, remember I said, you need to explain how your business is. What are the inputs? What are the outputs? What are the repayment cycles? What is the seasonality of the business? Let's say you have a uniform distributorship or a school. Let me pick even a school. A school gets inflows when terms open. That also informs the bank how to structure your facility and which facility to give you. Okay? So that's how the banks think. This speaks to what the credit policy is about.
Okay.
At this point,
Michael, I think just so that we're also just at the close 1 hour mark of the webinar. And I know we've talked about, first of all the documents I need to sell my soul for, what the other options are when I need to look for money. I know you've talked about the score, but now there's something we're not mentioning here. And I think it is the bane of most entrepreneurs. Like when you think about it, you just get stressed. And that is KRA. And KRA is coming for all of us. Like, all of us, a consultant, a business owner, all of us, KRA is coming for all of us. And I want to ask, there's a question I want to pose to Simon with regards to KRA. Where does the role of your tax person come in when it comes to doing the loan application? But before even Simon answers that question, I want us to run a quick poll here about compliance in terms of filing returns. Because again, sometimes we move with the wind and forget, oh, I need to file returns for the business. I need to do this for the business. And I'll just start the poll here just for us to find out on a scale of 1 to 10. Are we compliant? Are you compliant? Do you file returns, even if it is nil for the business? I want us to vote just quickly before Simon just comes in to answer the question. And yeah, I love it. KRA should be in this webinar just to see how people are very compliant, because there's no. People are very compliant. So are we compliant? Do we file nil returns, or do we follow the due procedure of what it means when it comes to KRA? I can see 12 people have voted yes. I love it. I love it. I love it. Compliance. KRA should be in this webinar. If you know someone in KRA, tell them there's a webinar people are having somewhere and all of them are compliant. They file their returns. We love it. I think as people vote, maybe Simon, over to you. What is it? First of all, my two questions. Where does tax come in when it comes to my loan applications as a business owner? And secondly, if I file nil returns, do I still qualify for a loan? Let's say I've not triggered the threshold. Do I still qualify for a loan even when I'm at nil returns? Simon, over to you.
Before Simon comes in,
yes,
I'll give you a quick answer and say this. All the bank wants to see as one of the requirements or the documents is a tax compliance certificate. If you have that, we are good to go.
Okay.
So over to Simon. What does tax compliance mean?
Yeah, thank you. Thank you for that. Indeed, I can confirm that tax compliance certificate has been and still is one of the key documents that the bank will request from you before you can get that disbursement of the loan. However, based on the experience in the recent times, it is not sufficient. The bank, I think they have noticed the trick and they have now gone a little bit higher. This is the reason. If perhaps you've been filing nil returns all through, and you happen not to be filing even the monthly or the monthly return, or you don't even have those obligations, then you are going to automatically get a tax compliance certificate. And I think they have come to realize this because initially compliance certificate was manual, but right now it's automated. So they have gone a little bit a notch higher because what I have realized a few months ago, there is a client who was trying to look for defunding. And when they came to me, they told me that I've been requested for my iTax password. So we started asking ourselves, okay, why would they want to get this iTax password? And see, now they want to finance us, but they want to confirm the status of our taxes. And so then you have two options: either give the password, they check, or don't give and you get the facility. But if you give the password now, what happens?
I'm still stuck at, so they went to the bank to ask for a loan and they were asked to give the password to their iTax.
It was a financier. It was not like a specific bank, but this financier works with the banks. So they do the due diligence for the bank before the bank can be able to release the money. So one of their due diligence is the tax status of the client. So what they realized is, and I think I get where they are coming from, because it's also a matter of trust. Because for someone to trust you with their money, then at least you should also be able to trust them with your documents. That's the bank statement, your tax status, and all these other things that have been mentioned in the previous slides. So what does this mean? Number one, this person is going to identify the filing history of you as a business. So what that means is that now you are going to be exposed. For example, if you say that you have salaries that you do the filing, and then in the financial statements, salaries are starting at 20 million, but they go to iTax, they find your salaries were just 5 million. So you'll be like, I think you are not honest with us. And that's what has been happening for the longest time. They're also going to look at the consistency on how you file your tax returns. Maybe you are the person who always file on June 25th to 30th of June. which means that you always do the last minute filing. They're also going to look at historical debts that you have with the taxman, which now tells them, now if you still owe the taxman a very small portion of your income, how will you be able to pay us back our loan, which is like 5 times or 10 times how much they want to lend you. So the other things that you are looking at is the VAT. You'll find there are some businesses that have not been able to get financing because they don't have the VAT obligations. Simply because it shows that it's either you are underfiling or you are not honest enough to the government that you should register for VAT, or then you don't have the capacity. Because when they do the comparison of your bank statement against your income statement against the filed returns, then they're able to tell if you indeed qualify for this. So something else that they look at in your tax position is existing tax disputes, which is very visible on iTax. You might be doing very well, but perhaps you have a tax dispute or worth of millions of shillings that if you are likely to lose, then it means your cash flow will be affected. So through iTax, they are able to tell that. So those are some of the things that I've realized and noticed that they are currently looking at, because the audited financial statements and the bank statement right now are not really sufficient to tell your tax status. Even the tax compliance is still not sufficient, because what's happening, you can have a lot of debt. You go and negotiate with the taxman, then you get a compliance certificate. But that does not mean that debt gets out of your iTax system. So they need this kind of an assurance. And therefore, what we are saying in this session is that the earlier you start practicing tax planning, the earlier you start the compliance, the easier it will be for you to be able to get a facility in future.
Okay, I'm just understanding that there's a lot of the shortcuts that people use are now being figured out. And I know we talk about bureaucracy where people take shortcuts to actually get the loan. So like now, Michael, you mentioned about having a relationship with your bank. And I know we've heard of stories where someone applied for the loan and they didn't qualify, but because they had a relationship with their relationship manager, they got the loan. But the catch is you give the RM a cut of the loan. I don't know if that makes sense.
Like I said, you also have to be aware that any relationship manager, any credit analyst, there are audits which will be done. And any bad loan that comes up in a discussion is your reputation. So ask yourself, is your relationship manager and that credit analyst who's anonymous, do you think they are willing to stake their reputation and their continued stay in that financial institution on taking that risk? That should be the biggest question. If you are buying something from a vendor on anywhere in Nairobi, for instance, if you're in Nairobi and they don't know you, or they cannot reasonably confirm that you will be able to pay them, do you want the salesperson in that shop or in that business to stake their reputation based on outside factors that you will be able to pay you and they give you their product? That's what in essence, a lot of us are asking from our relationship manager. And I don't think that a relationship with the relationship manager can cure bad records or bad statements. So from where I sit, I would want that the attendees and the businesses that we deal with follow the path where you have the records and your statements are in place and the governance is in place. You've spoken to Duncan or an auditor, an accountant. Simon has cleared you on the tax front and you're good to go. And then we've assessed and seen, are you ready? And then if that doesn't work, there's Doreen who will speak to what are the other alternatives? But like Doreen has mentioned, her path is sometimes even more stringent. So either way, I know, Wendy, you said you've sold your soul. If you believe that you're selling your soul when you're coming to a financial institution, I don't know how you'd call the requirements that Doreen will provide.
At this point, I think if I'm going to Doreen for alternative financing, I might have to sell a kidney. You know, my soul plus the kidney, just for me to acquire. At this point, if the measures under alternative financing are even more stringent, it means I'm selling my soul and my kidney. Like those two things, I'm like, yeah, it's fine. We need to grow the business. I'm willing to give you this. But there's a question around, some of the participants had asked a question. And for them, the biggest challenge is translating real business activity into something lenders can trust. How can they do that?
Okay. So like I said, there's the qualitative and the quantitative. And Duncan has gone to great lengths to tell you that your books have to be in order. The governance has to be in place. And once that, because that is telling me one side of the story, the other side is the qualitative. And Doreen deals a lot more with that than sometimes even banks do. So your relationship manager, like I said, your relationship manager is your biggest advocate, because they have to write a credit paper. And it tells the bank that they are in this industry. What are the risks inherent? Because, for instance, let me pick hotels. So someone runs one in the heart of CBD, they rely on walk-ins. And then another one is at the Masai Mara, for example. And they have contracts which are running for 1 year. So occupancy for Masai Mara, for argument's sake, is at 70%. They have this. It's contracts which have been running for the last 3 years, and they have been confirmed, and there's proper governance and all that. And then there's the one in town, they just rely on walk-ins. And then, for instance, every Tuesday, there are disruptions in town. So that starts slowing down the business. So if you tell your business, your relationship manager, how do you mitigate this? Because the bank wants to see or to understand, yes, can we stop disruptions or unforeseen circumstances? No. But do you have sufficient buffer in terms of even what Duncan was mentioned, retained earnings? Do you have a sufficient buffer so that when those disruptions come, you can still be able to pay as we wait? And also another thing that it's also important to mention is, like, the same way you would want the bank to tell you or to keep you informed about what is happening, it goes both ways. So you also need to tell, let's say you get the facility, you also need to tell the bank about what is happening. And it is very important that you tell them in writing so that it's documented, it goes to your file. Because you remember there's credit history, which speaks to your character. So if the last facility you are given, you had payment issues, it will impact your ability to get another loan. So you also need to be proactive in the communications that you do and have it documented. Everything has to be documented. I see a hand up.
Okay, I'm just trying to see who's Tony. Hi, Tony. Thank you so much for joining. So my ask is that please use the chat feature on the webinar to ask your question. Please use the chat feature. Then I'll read out the question to our panelists. And there's something you have mentioned, Michael. I just want to run a quick poll here now with regards to viability, and and the poll is just about to start. And I think it's just asking, just a minute. Okay, I can explain what I need the loan for with numbers to back it up.
Yes.
Okay, so as that poll is running, there's something you mentioned about going to the bank and And sometimes the business in town, Tuesday, they're affected by Mandamano, for example, and this is what is happening. So there's a bit of unsteadiness. So now that we are approaching an election year, which technically we've already started seeing, like, elections, and we know what elections do to business. During this season, is it possible for a bank to tell you no?
The quick answer is, you see, a bank doesn't make decisions on, it tries as much as possible not to be subjective. But if you tell me that as elections are coming, there'll be cancellations in terms of bookings, maybe you rely on tourists and there are cancellations, and that cycle has been seen in your business or that in your industry, that is the common verifiable fact, then the answer is yes. But the bank will not say that we know that during elections, town, there is going to be these things happening. Also, remember that during elections, there might be a boom for you. You might be in the printing business and you have contracts with certain players in the political space, and you have 4 or 5 contracts. That seasonality also provides an opportunity. Remember, the bank also is in the business of making money. It just has to balance it with the risk. So it will not make a decision that is subjective. It will look at what are the conditions, can they be verified, and then make a call. Or sometimes also there's the credit policy during, and these are internal documents which you might not be privy to. It might make a decision that certain industries we will not finance. That is outside your control. But if it has been decided that these are the kind of clients we will not finance during the election cycle, then yes, you will not get funding at that period. But you see, like I mentioned, it is seasonal. Once that period is over, they might lift the hold and then resume lending. So you just need to be aware. And if you talk to your relationship manager nicely, remember this is a person who wants to make that sale. They want to understand your business. If you can present it in a way that they understand it, they know it, and they can go all out for you, then you are in a good position.
Okay. There's a question from Paul, and he says, is it possible to get a more clear distinction in how the credit health profiling is distinct between the company as a separate legal entity and the directorship?
Could you repeat the question?
Is it possible to get a more clear distinction in how the credit health profiling is distinct between the company and the company as a separate legal entity and the directorship?
Okay. So how you form your company, and Duncan will weigh in on this, might want to weigh in on this. Your business could be running as a sole proprietorship, as a partnership, or a limited liability company. Okay? And all of those have certain implications on what the bank and who the bank can go after in case of a default. So if it is a sole proprietorship, you and the business are the same entity. So there's no distinction between you and the business. So if you default, the bank can come after you as well. Then there are partnerships also where you could be also in partnerships, the bank can pursue you. So it depends on the structure of the business. In a limited liability company, that's a distinct and separate legal entity. So when you take a facility and you have a limited liability company, you'll see that very many times the bank will require that all the directors give personal guarantees. Meaning that now that the business has borrowed, because the bank can sue the business and you can go scot-free, because like I said, they're different and distinct legal entities. Now, when you offer a guarantee, it means that the bank now has enjoined you in this. You're now a guarantor to the business as directors. I don't know if I'm answering the question that Paul has asked. So that's from a legal point of view, and how when that is being looked at from the banking point of view, it wants to show who is liable for any losses or any what's the word I'm looking for? In the event that the bank cannot get back its money, who can it go after? Yes. So it depends on how your business is structured. Duncan,
Yes,
you want to weigh
I
in?
think you put it quite clearly. There are various ways a business is structured. And then again, it all goes back to what we described earlier about governance. Now, you've mentioned sole proprietorship, you've mentioned partnerships. Then there's a third one, which probably you didn't mention, which is limited liability partnership. And then, of course, there's the limited liability company, what many people know as limited companies. Yes, all of those have different, I mean, the bank looks at them differently as to who bears responsibility. In case you default, they know who to come for. Thanks.
So thank you. Paul, I believe we've addressed your concern.
Okay.
So
I'm just reading through some of the questions, and I'll be sharing my screen in a bit in terms of some of the feelings that people have around it. There's a question: what do we need to do in advance to prepare a real estate development company for a loan application?
so I would ask that what is the purpose of the loan? The purpose is very critical. So for real estate, what are you borrowing for? Are you borrowing for land acquisition? Are you borrowing for innovation? Different loan requirements, different purposes will require different sorts of preparation. But once again, we need to understand what is the cycle of inflows for your business. That is very, very critical. So from the inflows of your business, you can be able to structure what kind of product and for how long you'll be able to borrow. So in terms of if you develop and then you're paid maybe at the end of the year, so what are you looking for? The seasonality of the inflows. So it would be good to understand the nature, like I said, before any decision is made and a credit paper is presented to the credit committee, they need to understand your business, because not all real estates are the same. There is real estate can be from management to all the other from buying and selling of plots, which I think it's speculative business. And a lot of banks, if you say you're in real estate, because I've also seen that people who buy and sell plots are in real estate. That is speculative business. So a lot of banks do not want to touch that kind of business.
Okay.
I don't know. Yeah.
Okay, so I think if you can just look at the screen, there are some questions that were asked by people who registered, and I think we've touched on a few of them, from the too many procedures, the delayed release of funds through lengthy credit processes. Is there a time where the bank considers unique circumstances, and maybe what are some of the unique circumstances you have seen? Because here it is lack of consideration for unique circumstances. And what would make a bank consider unique circumstances?
What are the unique circumstances? Yes. If let's say you have a contract, there's something which is called a letter of comfort. A letter of comfort is, let's say that you are about to sign a contract with an entity that is abroad, and everything it has not been signed yet, but the entity abroad is, or wherever, let me not even say abroad, it's a local entity, and they're able to give you what is called a letter of comfort. A letter of comfort, what it says in essence is, you can deal with this person in full confidence that we will honor, there's a revenue that is coming. For instance, let's say you're buying a car, a simple one. It might not be as unique, but there's something which a lot of businesses do not know that you can get. You can get something called a letter of comfort. Sometimes you're saying, release this thing to this person because I am going to sell it to them so that you pay me the financing. I don't know if I'm answering that question clearly, but I would want to know which unique circumstances are these. When you ask me about unique circumstances, can you demonstrate reasonably that there are inflows which are expected? Can we trust this information that you're given? If you have a unique circumstances, all the bank wants to see or understand is, how reasonably confident are we that we can get inflows to be able to pay for the facility? That is the fundamental and underlying question that has to be answered.
Okay. I really wish I knew what the unique circumstances were, and I wish the person who asked this question would maybe just jump in and let us know what the unique circumstance is. There's another question in the, or it's just not the, okay. So I'm really just curious just to understand what the unique circumstance is. And there's something we had mentioned about, number one, from your CRB status to your business. And I think this leads back to Paul's question about directorship and all those things. I just want to run a quick poll as we continue. Is my business is registered? So we are asking you, is your business registered as sole proprietorship, a partnership, or a limited company? Just for us to also understand, because I think how the company is structured affects how you get the loan, the dynamics of the loan, correct, Michael?
Yes, it could affect, yes. And
Yes.
I'm also seeing, sorry to interrupt, I'm also seeing approvals and duration.
Yes.
The credit assessment, if your financials are given to a credit analyst, it does not take them more than 24, let me call it 72 hours. They already know. If you give them documentation, because all banks have a credit assessment tool, it won't take them more than 72 hours to do the quantitative, because it's about ratios. And Duncan has spoken about them. Those ratios can be calculated within 72 hours. But now the real question comes in. That's the quantitative. The qualitative, can we understand this business? And then security. Like Duncan has mentioned, if it takes 3 months for security to be perfected or collateral, then you will get the money, and only when that security has been perfected. And if you see there's a back and forth, ladies and gentlemen, if there's a back and forth, it means that the information you've provided is insufficient. Your relationship manager does not understand your business. So it's upon you. And sometimes I'll not say all relationship managers are the same. Like I mentioned, a relationship manager could have a portfolio of sometimes 300 companies. If you want quick fixes and you've basically made a very generic business company profile where you've said we started in 2015 with 3 directors and all that, that is all well and good, but I need to understand, what is your concentration risk? Who are your customers? Your account receivables. What unique innovation do you have in your industry or where your sector that separates you from everyone else? How have you mitigated the key man risk? Those are the questions that the credit analyst wants to understand. So documentation, requirements, communication.
Okay, I think as we go through what's on the screen, Michael, there was a question from our LinkedIn, and I'll just read out a section of what I was able to extract as a question. How can we bridge the gap between documented structure and the operational reality of things? Because you find that a lot of people, like SMEs, start with governance, reporting, compliance, and all these things, but then when you test out the operational part of this, there is the asset control isn't clear, the process rely on informal workarounds, or the business behaves differently under real conditions that were not shown on paper. So how do we bridge the gap between documented structure and the operational reality that makes the business move from almost ready to fundable, or from unfundable to fundable? I don't know if that makes sense.
And that's why we at Hatuapic, what we've done is there's a clear SME readiness index where we are looking at where are you currently? Okay, which documents, like I've asked a quick poll. Do you have audited accounts or management accounts? Do you have them? Yes or no? Have you checked your CRB listing? Yes or no? Then your statements. What are your statements telling us? So if there's a structured way, which we have, whereby you can come and then we do an assessment, and then there's Duncan, there's Simon, who will be able to look at the audit bit. The documentation is done, then they are audited, then Simon looks at the tax compliance, then we put all these things together so that by that we tell you that, yes, there it is. There's a diagnosis. So once you do this, then it will bridge the gap, because we can't run away from the fact that the documentation is a requirement. And in the absence of it, the bank is not able to verify that if they advance you money, you'll be able to pay. So ladies and gentlemen, we need those documents and the discipline and the rigor on how we operate our accounts. And that's where Duncan comes in to audit and see, do we have these things in place? So for us to move to the formal banking side, and even Doreen will mention that you need proper governance, because the financier is taking a risk on your business. So you need to tell a story that is verifiable. That one I'll keep repeating. So it might look like it's bureaucratic, but the statements, the documentation has not changed. So if we know what the bank is looking out for, how do you present this in a manner that the bank can be able to approve?
Okay, I think, Duncan, do you have something to add on to that?
Yes, I just want to add on what Michael has spoken. And the key word there is verifiable, because we have so many businesses with very good documentation. They have financial procedures, they have everything. But when you, like they say, mambo kwa ground is different. You go there, find that, yes, they have all these documented processes, but are they really applying them? You find that they are not. So that's when the auditor comes in to actually verify each and every of those processes.
Okay, I can see Thomas has joined us. Maybe Thomas, you can add on to that.
Thank you, Wendy. Yes, just speaking into that, I think it's important that to realize that even as the person who asked the question said, when we go to work with these businesses, we always start with putting in the processes in place. You put in standard operating procedures, you'll document all those processes. But one of the things that we do differently is that then we work with you as a business, as an enterprise, to actually implement them and to ensure that what sits on paper is actually what is working and happening on the ground, so that it's verifiable, so that you don't just have good structures that are seated on paper only, but you actually have processes that are working, and these processes then are reflected in what is then documented and that. So it is important that even as you work with any consultant to just help you prepare your business and get your business ready for lending. As those structures are put in, let them not just end up on paper. Let them actually be, let them help you operationalize those items so that they're not theoretical. Thank you.
Okay, thank you so much, guys. Thank you so much. I feel like there's so much to learn, and I'm really grateful that this is a 3-part session and it's not just a one time and we are done, because next week again we are back. But next week when we come back again, we are continuing the series now to the part 4, the financial foundation and governance. And I know we have touched a bit on governance here, financial foundation and all those things. So next week now we are getting into the meat of things, of what is actually needed, because there's a lot of work that needs to go into you being ready to get a loan, and you being moving to the 20% that is fundable. There's a lot of work that goes into that. And I think our experts will cover that extensively. So don't worry. This is part 1. Part 2 is next week. Part 3 is the week after. So I am not worried at all, because next week we'll still have a chance to ask as many questions as possible. But I want to say that even as you've left this session today, I think it is just for go back and think, where am I in my business? Think about all the questions that we have just asked, from, do you have a separate bank account? Can you show 12 months of banking statements? Do you have a record of your income and expenses? Like either you've written it somewhere, or it's on an Excel sheet, or you use a system. Is your business registered? Are you compliant with KRA? Do you have permits? Do you have audited management accounts? Do you know your CRB status? And can you explain why you need a loan? So as we go think about and come back next week for foundations and governance, I think about those questions of, where am I right now, and what do I need to do to be viable, for lack of a better term, to be viable to get a loan from a bank, based off what Michael has shared. That being said, I don't know, Michael, if we have any parting shots for this webinar, because we're really out of time significantly, but just as a preamble into what's coming next week, maybe just share with us just a small bit into what's coming next week.
Thank you very much, Wendy, and I hope the session has been enlightening. So I've kept saying verifiable. That's the word. And even Duncan has mentioned it, and Thomas chimed in on the same. Next week, we will look at now in depth. What are the requirements, the actual requirements that are needed, and why are they needed? And we'll go into, and what does each requirement speak to? I know there's a frustration that there are too many requirements, but each of them speaks to something that the bank is looking out for. And the fundamental question that they all want to answer is your business viable, predictable, and can we verify that this information, which relates to the past, can it inform us about your future behavior so that we can lend you money and get our money back? So that's what we are going to be discussing. Hopefully we've set the context, we've laid the background and the stage for that conversation to happen. So thank you very much, Wendy, and thank you very much to all our audience for taking the time. I know it's at some point it gets a bit technical, but that's the nature of finance. So thank you very much. Over to you, Wendy.
Okay, thank you so much, Michael. Thank you so much, Duncan, Thomas, Simon. I think Doreen just dropped off by a bit, but I want to say thank you so much. If you do have questions, I will actually put our contact details at the end here, so you can reach out to us if you have questions about this panel. If you'd like to reach out to the panelists as well, please, the contact details are on the screen. Be happy to reach out to them. They'll be happy to connect you at the Sandbox. We are based at CMS Africa House in Kilimani along Chania Avenue. If you'd like to walk in, again, we are always ready, willing and ready to actually serve entrepreneurs, you being one of them. So please do walk by. You can send us an email at capital@sandboxvillage.com, or you can call us at 0715 723 342, or you can just come. Again, our doors are very welcome. We'll give you some tea, some water, as we get to interact with the experts a bit more. And I can't wait to see you guys next week, same time from 10, next week on Thursday from 10 a.m. to 11:30. If you do have questions, please don't forget to register for the webinar, and we will see you guys next week. Thank you so much and have a lovely Thursday.
Thank you. Bye.